Welcome back to the Behind the Well show. Your host, Roger Abel, back with Elias Randall. How'd you like that new house I sent you this morning?
Very nice. Nice place. We might go take a look at it.
It's always easier to spend somebody else's money.
Yeah, sure. You want to buy that house for me and then I'll live there?
Negative, Ghost Rider. Pattern's full. One thing, it's getting nice out. It's going to be like 55 this week, and I'm excited for that. You have any spring football you do? Do you do spring games?
Spring games, once in a while, I'll do some practices. I may get the opportunity to work a spring game, but we'll see. It's off season right now. Spring football starts in April, so cross that bridge in April.
So we're filming this show February 12th. That said, S&P's up 1.2% year to date. I bet if you ask most people how the stock market's doing, they would tell you it's not doing good right now. Just because one sector's had a pretty big sell-off. Specifically software companies.
Yeah, there's some sectors that have done pretty well.
Yeah. One of the funds in one of the portfolios I was looking at was up like 5% year to date. I'm like, oh, really? It was a laggard last year, but doing fairly well this year. What brought that to my attention, though, is I think people are back to thinking about how do we time the market, right? Get a little volatility. People are like, man, should we get out? They're starting to get jittery. And Hartford just released their 2026 kind of guide to market timing, the reasons why you shouldn't do it. And they just summed up 2025. And this is what you need to know. If you just owned the S&P 500 from January through December at 100%, right? There's no diversification here. It's just the S&P 500 only. Not that that's not diversified, but just S&P 500. That did around 17%. If you missed the best day, you did 7.64%. If you missed the two best days, so you just got out on the wrong day, right? You missed the two best days, you did 4.23%. If you missed the four best days, you lost 0.5%. Think about that. Just 1 or 2 days is all the return for the year. And guess when those days likely came? After the most volatile days. And that's what makes timing so difficult, because people aren't selling on the day when the market's up 7. They're going to sell when it went down 4 and like, man, I got to get out. That's how the brain works. And I know what day the best day was. The best day, it was up 9.52%. It was April 9th. And that was when Trump announced the 90-day pause on tariffs. And so just coincidentally enough, I was talking to a client that morning. It was like 10:30, 11 a.m. And they were getting ready to take a trip. And they're like, maybe we should just hold off on this trip. It wasn't much. I'm like, guys, don't hold off for your trip. Just schedule your trip. I go, the market could go up substantially at any given time. Literally, like any time it could just go up and be right back to where it was. And I didn't know it was going to happen. At 2:00 in the afternoon, I called them back. I said, hey, by the way, remember how we talked about the market could go up anytime? It's up 7% since I talked to you.
And that was triggered by an announcement of a 90-day pause
on tariffs. That's it.
Tariffs.
But most people, that's about the time they were bailing out. Because if you remember, the tariffs, all the tariff talk came out on April 2nd. So April 3rd, the market was down 4.83%. April 4th, it was down almost 6. So we're at 10.8%, down another 3.5. So down 3.5 on April 10th. Those were the worst days of the year. So within a 7-day period of time, the market was down 15%. And I got this call from several people. Hey, bud, I think maybe we should get out. It's going to get worse. I said, how do you know? I just think, and I can talk them off the ledge. And sure enough, it didn't get worse. But that's about the point where people start to make changes. They start like, whoa, what's happening? And that's a fast move. I mean, 15% in 7 days. I actually think for most investors, it's better when it's quick like that because they didn't really have time to get out. If you think back to 2022, dude, that was just a slow grind down 25%
throughout the year,
where COVID, it was quick, relatively quick. Tariff, relatively quick and quick recovery. 2022 is a grind.
April 4th, 2025, market was almost down 6% in a day.
Yeah.
That is a lot.
That's a big move.
And it does feel when it's happening. And everyone was saying it wasn't just retail investors. It was the financial media, everyone. Oh, this could definitely get worse before it gets better. This is definitely going to get worse before it gets better. What I think is interesting about this chart, and I did not remember. I'm sure that week I was aware, but just going off memory, October 10th, 2025, down 2.7% in a day. I don't recall that. So I wonder how many people, everyone remembers April last year. That one's really memorable. But if you asked people, hey, what was the worst trading day in the fall in 2025? How many people, remember beginning of October, there was a negative 2.7% day. I doubt a lot of people remember that.
Wasn't that revolving around a government shutdown?
Possibly, and there was some tariff threat.
No, more tariff stuff.
Yeah, this chart says there was a tariff threat tied to rare earth minerals from China.
That's right. It just goes to show there's going to be volatility in markets. And this year we've seen the commodity markets be hyper volatile. I mean, there was one commodity went down, I can't mention what it is, but a very popular commodity that went down 30% in a day. And no one would think that the commodity market would have that amount of volatility. But when those markets go down 30%, it scares people. And now they've kind of come back. I had one client in my office. We were talking about this, and he had some of this commodity. I said, well, and it hadn't hit its peak yet. And he said, what should I do? I said, well, I don't know. Maybe just take out your basis. Like, maybe you'd think about taking out what you put in and letting it ride. After that, like, play with the house money.
What did he do?
He took out his basis, and then it went down 30%.
How's he feel about that?
I haven't talked to him. I think he's okay.
Seems like a good move.
But he was positive it was going to go 4 times higher when he met with me.
And then went down 30%.
30, yeah.
Okay.
I mean, he was positive.
Doesn't mean it still can't go four times higher.
But I think those are just good risk measures. Like, if you have an individual stock that you bought and it went up, if it's 5x'd, what's the worst thing about just taking out what you paid for it, and then it's just all house money? Right? If you take out what you put in, you can't lose. You're not going to lose your money. You're getting back what you put in. It's like principal protection.
I guess that's a decent.
No one ever looks at that. I do that a lot. Oh, well, I put in X. I'm in the money. Great. I'll take my principal out and put it somewhere else. And then I've kind of locked in my gain. Like,
what do you do with your original investment when you take it out? Then what
something
do you
different
do
with it.
I just feel have a standard move. It's whatever you're.
Yeah. And I just feel good about doing that because now I don't really care what happens, especially if it was like speculative. I don't do very much speculative stuff, but I've gotten lucky on a few things. You like how I called it luck? Luck.
Hey,
I mean, individual stock picking for the most part
is
luck.
It's better to be lucky than it is to be good.
But if you start to look at all the big moves, this puts people on edge and goes back to my original thesis, Elias, as to if you ask somebody how the stock market's doing right now, most people are going to tell you it's not good. And it's because they're looking at the commodities. They're looking at the tech sector. They're like, man, it's a horrible year. Well, not really. The S&P's up 1.2%. That's 0.6% a month. If we did that for the whole year, it'd be 7.2%. That wouldn't be a horrible year.
And it's just the beginning of February. We're just getting started.
We're just getting started.
And I don't think anyone. So here's something interesting. All the 2026 outlooks that I read going into the year, have looked at, all the institutions were calling for market being higher at the end of the year than at the beginning is the pretty standard call right now, but also to expect volatility. And I think we've been saying for the last couple of years, you should expect volatility in the market, and maybe more volatility now than what we've seen. But even if you just go back 3 years, 4 years, the market has been volatile. We've had a bunch of events, had things that have happened. But what has the net result been for investors that stayed invested and did the things successful investors do? Pretty good result.
Mostly positive.
And if you're just looking at year to date, I guess maybe you could say, yeah, the market's not doing that good. But what are your returns over the last 2 or 3 years?
Here's what's ironic. If you just own the S&P 500, your cumulative return over the last 3 years is, and this is what people really don't think about. Got to do the math. I don't have it in my head. So your cumulative return would be around 64% over 3 years, right? So you're going, man, that's a 20% average. But take out the 25, the market was down in 22, so you've averaged 39. Guess where our 4-year average is at?
Where?
9.75, right around 10%, which is
it's the historical average. And it's going to always,
most things are going to revert to the mean over time. There's going to be times of volatility that spikes and goes up, but over time, volatility reverts to the mean. And it's so ironic that returns just seem to revert to that as well. But if we look at any small period of time, it could be out of whack of that.
And you have to be prepared. I think anytime you choose to be a stock market investor, you should be prepared for that at the beginning. To invest your money in the market and then be surprised when there's volatility, that's a predictable event. You might not be able to predict when it will happen and what will cause it to happen. So I'll use an officiating analogy. So I officiate for a hobby, football. So one thing, when I'm working with a new, younger football official, I ask them, one of the things I teach them is if you go into a game and your expectation is that the coaches will agree with every decision that you make and that they won't argue with you throughout the duration of the game, you have set an unrealistic expectation for yourself. Coaches disagreeing and coaches having questions and coaches arguing with you about the decision you just made are predictable events. And you should be prepared to manage those. Just like market volatility is a predictable event. You don't know when it's, okay, when I'm reffing a game, I know when the volatility is going to happen during the game. If we kick at 7, it's going to happen between 7 and 9:30 tonight. In the market, you don't know that, right? You don't know when the volatility is going to be there, but it's still predictable that it will be there at some point.
Well, that's proven. Average drawdown's around 13% a year. Top to bottom, there's a 13% drawdown throughout the year. I don't know. You listen to Tom Lee a lot, as do I. I just saw an interview he did where he's on a podcast. He expects a pretty good drawdown at some point this year, but still finishing the year significantly higher than where we started. But he sees a significant
Tom Lee's
drawdown.
Very good at setting realistic expectations for people.
Yeah. You know what's interesting is realistic expectation is you're going to have volatility. It's going to pull back. I don't know when. And then it's going to push significantly higher towards the end of the year. That's all he said. But that's realistic. It's what happens most years.
He's not perfect because he puts out projections, right? And it's hard to predict the future without a crystal ball. He tends to do his price targets are pretty solid. If you look at his record over the years, he does a good job.
Do you want to know?
And he's not scared to admit when he's wrong. That's the other thing I respect about him. He will publicly state I was wrong about this. I've even heard him say on TV, I feel as if I have egg on my face at this point, where there's other predictors and people that talk negatively, but then they just every time they're wrong, they kick the can down the road. Tom doesn't tend to do that. He tends to just own up to it and say, but this is where I think we're going now. Yeah, I was wrong, but this is what I think is going to happen now. He doesn't just kick the can down the road on his expectation.
Have you ever heard Harry Dent say he's wrong?
No, Harry Dent's never said he's wrong.
He
says I'm not. He said I'm gonna. He always says I'll be right in 3 more months.
Do you think that's ironic that the guy who is not a perma bull but sees the glass half full in Tom Lee is willing to admit I was wrong, but all the guys who live in the world of fear and the market's coming to an end, we're having this huge collapse, all this stuff, they'll never admit they're wrong. They're like, I just wasn't right this time. I'll be right in the future. Well, yeah, no kidding. Of course you will be.
Yeah, I guess I view that and Tom Lee's approach as one, more mature and more wise. Just in general. To say, oh, I'll be right down the road. I'm not right yet. Those are just excuses.
Do you remember last year when we kind of had our whole thesis of the year was about rules of thumb and kind of myth busting the rules of thumb?
Yeah.
I found an article on MSN that I thought was great, and it's titled "The One Retirement Myth You Can't Afford to Believe." And it probably is the number one myth of retirement that people just get wrong, because we see the real spending habits of people and how it works. But the myth is that there's a lot of people that believe once they retire, their spending is going to shrink drastically. Why do you think people have that myth? Why do you think people think their spending's going down?
Very good question. I have not thought about where that originated and started. I think it's a general just thought that people have. I think it's kind of something that's accepted as a truth. But for whatever, I don't know why. Why would someone think that? Maybe they think, well, my kids are grown up. They're probably not living off mom and dad anymore.
Here's the two things I hear
I don't
most.
know. I actually don't know why people think that.
Here's what I hear most. My house is going to be paid off. That is valid. That doesn't mean it's free and that you're not going to spend on it. Like if you have a paid for home, there's still taxes, there's insurance, home maintenance. Okay. So I will.
Your cash flow is not improving the total payment. You just won't have the
P&I.
Principal and interest anymore.
So that expense went down. But here's the second one I hear people tell me all the time. And you tell me what you think of this. I won't be saving for retirement anymore. And that's true, right? But that's not a spending account. That was a savings account. That's not spending. Think about that. People see their retirement as spending. Oh man, because they're saying, well, I won't be putting that $800 a month in my retirement account anymore. Yeah, you're going to be pulling it out. You're right. Works opposite. Most people's spending works like this. For everybody listening who's close, here's how it works. The first 5 to 10 years, you're likely spending more than you did when you were working. It's almost certain. And here's why. You have all day. You don't have, when you spend 8 hours at the office, you and your wife go to the office or whatever you do for a living, you spend 8 to 10 hours a day working and driving and getting ready, and you come home and you're tired and you're just going to have a little meal at home.
No.
You don't have any time to do that. When you hit retirement, guess what happens? You wake up at 8:30, you have your coffee. Man, I'm kind of bored. Maybe I'll go to Home Depot today. Guess what? Not free. You're not walking out empty-handed out of Home Depot. Or you go to the coffee shop or you go out to lunch with your friends. Like your spending is going to increase. We can go down the list of clients that we've seen this, especially in the first 5 years. Just buying things they typically wouldn't buy when they were working, and not because they didn't have the money, but because they didn't have the time.
Well, and in line with this general idea, assuming the myth of people assuming that their spending will go down substantially in retirement, it's funny, the number of retired clients that have said, I didn't realize we were going to spend this much money on gas for the vehicles. But that goes to your point that you're saying. It's not that you're driving these longer distances at any one shot, but while you're working, you have your standard commute there and back. Most days it's there and back. Well, if you go to the coffee shop and then you go to the pickleball courts,
Costco,
and then you go to Costco, and because you have free time, I think I think people they're not as worried about being as efficient on their grocery trips. I think retired people go to the grocery store more frequently than they used to, right? So then you go to Costco or wherever you get your groceries. Oh, and then there's a group of people playing cards at the golf course. So now you head there. Well, you do that 5 times a week. You put on more miles than just driving to and from work.
People, I think this is what individuals getting ready to retire should think about. And we talk about this a lot. We have our investor guide series that tackles this problem. It is really envisioning what retirement's going to look like.
So go ahead.
And most of the time, people haven't thought about it. And spending more is not a problem as long as you've accounted for it, right? If you sat down, envision retirement, you know what you're going to spend. Spending more is not a problem. We're not telling people not to spend more. But anytime you have more time on your hands, you have more time to be a consumer. When you're at work, you don't have time to be a consumer. You have to work. When you're not working, you have just significantly more time. You're getting marketed to, and you're in the consumer world.
Well, and when people set out to have a realistic retirement budget or retirement spending, retirement income strategy, however you want to look at it, okay, well, I think to even be in the ballpark of realistic, one, it has to be what you're spending today at minimum.
Plus some for the first few years.
Right. And you could even increase it. Do you think 20%? Like what would just be a standard? Hey, if you look at your situation, you increase it 20 or 25%. Now you're probably looking at realistic.
I'd really caution anybody to just put a percentage on it because it depends on what you're going to do. Like it depends on what you enjoy doing. If you enjoy traveling, it could be 50% more.
So you're probably to come up with that's a good point. To come up with the realistic budget, you're better defining needs, wants, desires, wishes.
Here's a great example. I have clients right now. The wife travels, but the husband never goes because he doesn't want to travel.
The wife goes on vacations?
Yeah, go with her sister or daughter and stuff, but the husband doesn't like to travel. So they probably have it dialed in because when one spouse doesn't want to do something, it's really hard for the second one to really ramp it. Right. But if both of them are traveling, I guarantee you their travel expenses going up.
Double whatever it is now.
Right. But so that's where you have to look at your family dynamic and figure it out. Like the family I'm thinking about, he's actually the guy who probably wouldn't spend more in retirement. He'd spend exactly the same.
Which I would say
because he doesn't need for much. He wants to hang out in the garage, play with his cars.
I would say that those folks do exist, but they're the exception.
Yeah, I think the number one thing we hear from people, we want to travel, we want to go see our kids or grandkids, and their family all lives in town, so they don't have to travel to go do that. But a lot of people, they have a kid in Florida, one in Arizona, one in Minneapolis, wherever.
And good luck if you have grandkids spread out throughout the country and you think you're going to retire and not travel to see your grandkids, that's an unrealistic thought too. Dude, you're going to have expenses because you're going to want to see them.
I have a client who the wife, she's grandma, drives 2.5 hours every week on Tuesday, Wednesday, Thursday to go watch her grandkids in a different city.
She commutes
2.5 hours.
Both?
No, she'll stay down there for like 2 nights.
Oh,
right.
Wow.
But she stays with the family. But either way, like that's an expense. And grandkids aren't free. What about Chick-fil-A, bud? Oh, Grandma, take us to Chick-fil-A.
Yeah.
Can we go to Poncheros? Can we get orange leaf?
She's not saying no when she's there. Because she drove, right, her mentality. I'm driving 2.5 hours.
I'm going to do whatever these kids want.
Right. We're going to have fun.
Yeah. People don't think about that. Though I just think if you're thinking retirement's going to be significantly less expensive, it's a false reality of what actually happens. Doesn't mean it won't be your situation, but I think that's the number one myth that we see with people approaching retirement is believing that you're going to spend significantly less money in retirement. If anybody wants help with that, there's a link in the description to our investor guide series. We have some really good materials on how to start thinking about retirement. Also, we'll make sure to put our guide to volatility in there. A lot of people really like that guide, especially right now when we see certain markets being very, very volatile on the year. I want to thank everybody for listening. If you like our content, please do us a favor, hit the like button, subscribe to our show. We want to keep getting the content out to as many people as possible. Elias, with that said, do you have anything you want to say to listeners?
Thank you for listening. Appreciate it.
Thank you.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. Dollar cost averaging involves continuous investment in securities regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. A plan participant leaving an employer typically has 4 options and may engage in a combination of these options, each choice offering advantages and disadvantages. Those options include leave the money in their former employer's plan if permitted, roll over the assets to their new employer's plan if one is available and rollovers are permitted, roll over to an IRA, or cash out the account value. Consult your tax professional about eligibility to Roth and traditional IRA contributions. Contributions and earnings in a Roth IRA can be withdrawn without paying taxes and penalties if the account owner is at least 59.5 and has held their Roth IRA for at least 5 years. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of the conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA.